You're sitting at your kitchen table late at night. The lights are dim. The house is silent. Everyone else is asleep. But your mind isn't. Your mind is racing, calculating, worrying about something you've been avoiding thinking about for years. Your phone is open to something you wish you hadn't looked at, your retirement account. 401k, IRA, maybe a pension if you're one of the few still lucky enough to have one. That increasingly rare thing that feels like a relic from another era. The number is there. The number you've been told your entire life would guarantee safety one day. Security. Peace. The reward for decades of work. A number that's supposed to grow quietly in the background while you work, age, save, invest, and eventually earn your rest. But as you stare at it, as you really look at what's actually there, something feels wrong. It's too small. Way too small. Nowhere near what the retirement calculators say you'll need. Nowhere near what financial advisors told you to aim for. Nowhere near enough to actually stop working and survive for 20 or 30 years. And deep inside, in that place where you keep truths you don't want to acknowledge, you know it's never going to be enough. No matter how much you save from here forward, no matter how carefully you invest, no matter how disciplined you are with your budget, the math just doesn't work. The gap between what you have and what you'll need is too large to close with the time and resources available to you. You close the app. You lock your phone. You sit there in the dim light, taking a breath, trying to calm the anxiety rising in your chest. But that tight feeling doesn't go away. Because this realization, this cold, uncomfortable truth, isn't something you can just swipe away or ignore. Because this isn't just about your retirement. This isn't just your personal failure to save enough, or invest wisely enough, or plan carefully enough. This is something bigger, something systemic, something happening to millions of people simultaneously. A quiet crisis that nobody wants to talk about openly, because acknowledging it means confronting the fact that the deal we were promised, work hard, save diligently, retire comfortably, has been fundamentally broken. You can feel it even if you can't fully explain it, even if you don't have all the economic data or policy analysis. You can feel that something has changed, that the path your parents took isn't available anymore, that retirement as they experienced it, as a guaranteed phase of life earned through decades of labor, is slipping out of reach for your generation and the ones coming after. If you've ever looked at your retirement account and felt sick, if you've ever done the math and realized it doesn't add up, if you've ever wondered, how am I supposed to retire when I can barely save anything? Comment yes. Because a lot of people feel that exact same thing. That same dread, that same realization that they're heading toward old age without the financial foundation they were told they'd have. We were sold a story, a beautiful, comforting, almost cinematic story about how life is supposed to work. About the arc of a successful adult life in America. Work hard, go to school, get a job, climb the ladder, save money, invest wisely. Watch your nest egg grow. And then, at 65 or so, after decades of labor and responsibility and showing up every day, retire. Stop working. Enjoy your golden years. Travel. Spend time with grandchildren. Pursue hobbies. Live comfortably on the savings and pension and social security you've accumulated. It's the story your parents believed. The story the education system teaches implicitly from childhood. The story your employer encourages through 401k, matching, and retirement planning seminars. The story the entire financial industry is built around. Mutual funds, target date funds, IRAs, annuities, retirement calculators, all based on the assumption that retirement is a normal, achievable phase of life that everyone progresses to. A story that, for a specific generation in a specific historical moment, actually worked. For many baby boomers and their parents, this wasn't fantasy. This was reality. Millions of people actually did work for one company for 30 years, retire with a pension, collect Social Security, and live comfortably until they died. The system functioned. The promise was kept. But that story, that version of reality, is dead. It died gradually over the past 40 years, killed by policy changes and economic shifts and corporate decisions that fundamentally altered the relationship between work and retirement. And you weren't told. Nobody sat you down and explained that the rules had changed, that the deal your parents got is no longer on offer, that you're playing a completely different game with completely different odds. Because the modern retirement system, the one built for you, the one you're supposed to rely on, the one you've been contributing to for years or decades, is not designed to let you retire. Not comfortably, not sustainably, not for most people. It's designed to keep you working, for as long as possible. Ideally until you're too old or too sick to continue. And if you do manage to stop working, it's designed to provide just barely enough support that you don't starve or become completely destitute, but not enough to actually live with dignity and security. Not officially, of course. Not in writing. Not in any policy document that explicitly states we've designed a system where most people can't retire. But in outcomes, in results, in what actually happens to millions of people who did everything they were told to do and still end up broke or working into their 70s or depending on adult children or returning to the workforce after retiring because their money ran out faster than their life did. And outcomes don't lie. This is educational storytelling about money, retirement systems, and economic trends, not financial, legal, or retirement planning advice. Everyone's situation is different, and retirement rules vary by state, employer, and individual circumstances. This video analyzes structural trends, not personal financial guidance. Always consult qualified professionals before making retirement decisions. So let's start with the simple, uncomfortable question that more and more people are quietly asking themselves. Why can't people retire anymore? Not rhetorical, not abstract. Actually look around and answer, why are 65-year-olds stocking shelves at Walmart? Why are 72-year-olds driving Uber? Why are 80-year-olds greeting customers at Target, standing for hours in those red vests that seem designed to broadcast, I needed work so badly I took a job that teenagers normally do? Why are retirees, people who supposedly already retired, who left the workforce, who were supposed to be done, going back to work? Not because they're bored, not because they miss the office camaraderie, but because their money won't last. Because the expenses kept coming, and the savings ran out faster than expected, and now they're 68 or 73, and they need income again. Why are people who did everything right, who got degrees, who worked stable jobs for decades, who saved regularly, who didn't make crazy financial mistakes, still ending up broke or nearly broke in old age? Why does it feel like retirement has become a luxury item? Something available only to the wealthy, the lucky few with huge pensions or inheritances or stock options, or the already retired who got in under the old system before the door closed? The standard answers, the ones you hear from financial advisors and personal finance gurus and boomer relatives, are usually some version of, people are irresponsible, they don't save enough, they spend too much, they make bad choices, they didn't start early enough, they didn't invest wisely, they bought too much avocado toast and too many lattes. But those answers don't explain the scale of what's happening. If retirement failure was just about individual irresponsibility, it would be scattered and random. But it's not. It's widespread. It's affecting people across income levels, education levels, career types. It's affecting people who absolutely were responsible, who did save, who made reasonable choices within the constraints they faced. The real reasons run deeper, much deeper, and they're structural, not personal. They're about how the economic rules changed while the cultural expectations stayed the same, about how corporations shifted retirement risk from themselves to workers, about how costs exploded while wages stagnated, about how a system designed for one economic reality is catastrophically failing in a completely different one. And the more you learn about these structural changes, the more you realize an uncomfortable truth. You were never meant to retire comfortably, not under the modern system, not under the rules that exist today. The system wasn't designed with your comfortable retirement as a goal. That was the marketing. That was the story they told you to keep you compliant and working. But the actual design, the actual incentives and structures, those are built around keeping you economically insecure enough that you can't stop working. Let's go back a bit, not far, just 40 to 50 years, one or two generations, because understanding how dramatically things have changed requires seeing what retirement used to look like. A generation ago, for your parents or grandparents, depending on your age, the formula was relatively simple and actually worked for millions of people. One job. You worked for one company, maybe for your entire career, at least for a very long time. Job hopping was rare and often viewed negatively. Loyalty was rewarded. One pension. That company provided a pension, a defined benefit plan, where they promised you a specific monthly payment for life after you retired. You didn't manage it. You didn't worry about market performance. You just worked your years, and the company guaranteed you income afterward. One income supporting an entire family. A single wage earner, usually the father in that era's gender dynamics, could support a spouse and children. Buy a house, afford a car, pay for occasional vacations, save a bit. Middle-class life on one income was achievable. Affordable housing. A house cost roughly 2 to 3 times the median household income. Mortgages were manageable. Home ownership was accessible to working-class families. Affordable health care. Medical costs were a fraction of what they are now, relative to income. Insurance was often provided by employers at little or no cost to the worker. Medicare covered much of what retirees needed. Affordable education. College was cheap enough that you could work part-time and graduate without debt, or with minimal debt that was easy to pay off. This wasn't just for the wealthy. State universities were genuinely affordable. Wages that grew with productivity. When workers produced more value per hour through better tools and processes, their wages increased proportionally. Productivity gains were shared between owners and workers. Retirement at 60 or 65. This was normal, expected, achievable. People actually stopped working in their early to mid-60s and lived on pensions and Social Security. A peaceful, relatively simple life afterward. Not lavish, but comfortable. Enough money to live without working. Time for family and hobbies. Security. It wasn't perfect. It wasn't universal. Plenty of people, especially minorities and women, and those in certain industries, were excluded from this system. But for a large segment of the population, particularly white men in stable industries, it genuinely worked. The promise was kept. Work hard, the system takes care of you afterward. And it actually did. Now look at today. Look at the economic reality you're actually living in. No pensions. They've almost completely disappeared from private sector jobs. Only about 15% of private sector workers have any pension at all, and that number keeps falling. If you work for a company, you get a 401k if you're lucky. And that's it. No guaranteed income for life. Just an account that you fund, you manage, you take all the risk on. Stagnant wages. Adjusted for inflation, wages for most workers haven't increased meaningfully in 40 years. You're working harder, producing more, but taking home essentially the same or less buying power than workers in 1980. Exploding housing costs. A house now costs not 3 times median income, but 8 to 12 times or more, especially in cities where jobs actually exist. Home ownership has become increasingly out of reach for younger generations. Medical debt. Healthcare costs have exploded. Insurance is expensive and covers less. Medical bills are a leading cause of bankruptcy. Medicare has gaps. Long-term care is ruinously expensive. Student loans. College became unaffordable, so students borrowed. Now millions are carrying debt that takes decades to pay off. Debt that delays every other financial goal, including retirement savings. Two incomes barely covering basics. You need two full-time incomes to achieve what one income provided a generation ago. And even with both partners working, many families struggle to cover rent, childcare, healthcare, debt payments, basic necessities. Gig jobs with no benefits. More and more work is temporary, contract, freelance. No employer-provided healthcare, no 401k matching, no job security, no benefits at all. Just income, and often inadequate income, with all risk on you. 401ks replacing guaranteed pensions. The retirement risk has been completely shifted from employers to employees. They contribute a bit if you're lucky, but you bear all the investment risk, all the market risk, all the longevity risk. Markets crashing every decade. Dot-com bust, financial crisis, COVID crash. Every decade, some major market event wipes out a significant chunk of retirement savings for people who were depending on steady growth. Inflation eating savings alive. The official inflation numbers say 2 to 3%, but real costs for things people actually need, housing, healthcare, education, food, rise much faster. Your savings lose purchasing power constantly. Retirement age pushed higher. Social Security full retirement age has already been increased. Politicians regularly discuss increasing it further. Early retirement penalties are harsh. The system is structurally designed to get you to work longer. Life expectancy rising, but only for the wealthy. Poor and working class people aren't living much longer than they used to, but wealthy people are. So if you're not wealthy, you might not even live long enough to enjoy retirement. And if you do, you'll spend those years in worse health. This isn't the same world. This isn't even a similar world. The math simply doesn't work anymore. The formula that led to comfortable retirement for millions of boomers leads to poverty and decades of continued work for millennials and Gen Z. For the average American today, and especially for younger generations, retirement, in the traditional sense, isn't a phase of life you progress to after working. It's a myth. A story we keep telling even though the underlying reality has completely changed. Drop retire. In the comments if you've noticed that retirement feels more and more like a fantasy with each passing year. Because acknowledging that this isn't just you, that this is a widespread structural reality, is important. You're not failing at an achievable goal. You're facing an impossible standard created by a broken system. Let's talk about why the retirement illusion exists. Why we're still being sold a dream that the system can no longer deliver. Why the expectations haven't updated to match the reality. There are three foundational pillars that explain how we got here. Three major structural shifts that destroyed the old retirement system without replacing it with anything that actually works for most people. Understanding these pillars makes everything else make sense. Makes it clear why you're struggling, why the advice doesn't work, why the system feels rigged against you, because it is. Pillar 1. The system shifted from guaranteed to you're on your own. Until the 1980s, most Americans with stable jobs had pensions. Defined benefit plans, where defined benefit means exactly what it sounds like. The benefit, the retirement income, is defined, specified, guaranteed. Pensions were simple, beautifully simple. You work for the company for a certain number of years. When you retire, the company pays you a specific amount every month for the rest of your life. That amount is determined by a formula based on your years of service and salary history. You don't have to manage investments. You don't have to worry about market crashes. You don't have to calculate withdrawal rates or worry about outliving your money. The company guarantees you income until you die. It wasn't a favor. It wasn't charity. It wasn't optional. It was part of your compensation package. You earned it through your labor. The company made a promise and was legally obligated to keep it. But pensions had a problem. From the company's perspective. They were expensive. They created long-term liabilities on corporate balance sheets. They required companies to fund retirement obligations for workers who weren't actively producing anything anymore. They transferred longevity risk to the company. If you lived to 100, the company had to keep paying you. So starting in the 1980s, corporations realized something. What if we could get rid of pensions and replace them with something much cheaper that shifts all the risk to workers? And they did. They replaced defined benefit pensions with defined contribution plans, primarily 401ks. Do you know who invented the 401k? It wasn't designed by workers or labor unions or economists trying to create better retirement security. It was created by tax lawyers and Wall Street, by financial services companies, by money managers who saw an opportunity to create a massive new market for their investment products. The 401k is named after a section of the tax code, Section 401k, that was originally meant as a supplementary savings vehicle for executives, but it got repurposed and expanded and turned into the primary retirement vehicle for most American workers. Here's the fundamental difference. Pensions were employer risk. The company bore the risk. If the market performed badly, that was the company's problem. If people lived longer than expected, that was the company's problem. If investments underperformed, the company still had to pay the promised benefit. The company managed everything. You just collected your payment. 401ks are your risk. You bear all of it. You have to decide how much to contribute, and most people can't afford to contribute enough. You have to decide how to invest, and most people aren't financial experts. You have to manage the account, rebalancing, adjusting asset allocation, monitoring fees. You have to hope the market performs well during your working years, and especially right before you retire. You have to figure out how to make the money last for an unknowable number of years. You bear the risk of market crashes, inflation, living longer than expected, making bad investment choices, paying excessive fees. And the financial industry? They get paid either way. Win or lose, bull market or crash, whether you retire comfortably or broke, they collect their management fees. Your retirement success or failure doesn't affect their profit. Only your continued participation in the market matters to them. That's pillar number 1. The retirement security system was fundamentally restructured to shift all risk from employers and institutions to individual workers. And individual workers, unsurprisingly, aren't handling that risk well. Because they're not trained to. Because they don't have the resources to. Because the system wasn't built for them to succeed. It was built to be cheaper for companies and more profitable for Wall Street. Pillar 2. The cost of living grew faster than the ability to save. Even if the shift from pensions to 401ks was neutral, which it wasn't, it was massively disadvantageous for workers. People could theoretically still save enough in a 401k to retire if they had adequate income and manageable expenses. But they don't. Because while wages stagnated, the costs of everything necessary for life exploded. In 1980, a house cost roughly 3 times the median household income. Today, depending on where you live, a house costs 8 to 12 times median income or more. In many cities, much more. That means instead of saving the difference between 3 times income and your down payment, you're trying to afford something that requires decades of massive debt payments. Money that could have gone to retirement savings instead goes to mortgage interest. Prescription drug costs have tripled relative to income. Healthcare costs have doubled or more. Insurance premiums skyrocketed. Deductibles increased. Out-of-pocket maximums grew. What used to be a manageable part of a family budget became a financial emergency waiting to happen. Education costs quadrupled or more. College went from something you could afford by working part-time to something that requires tens or hundreds of thousands in loans that take decades to repay. And now those loans delay everything else. Buying a home, having children, saving for retirement. Childcare costs exploded. In many cities, full-time childcare for one child costs as much as rent. For 2 children, it can exceed rent. That means one parent's entire income might go just to childcare, leaving nothing for savings. Cars now cost as much as houses once did. What used to be a few $1,000s for a serviceable vehicle is now $30,000, $40,000, $50,000. And you need a car in most of America because public transit barely exists outside a handful of cities. Meanwhile, wages barely moved. Adjusted for inflation, the median wage today has roughly the same purchasing power as in 1980. All those productivity gains from computers and technology and better processes, they went to owners and executives and shareholders, not to workers. So you're expected to save for retirement out of income that hasn't grown in real terms, while paying for housing that costs 3 to 4 times as much, healthcare that costs double, education that costs quadruple, childcare that didn't used to be necessary because one income was enough. The math doesn't work. You can't save for retirement if every dollar is consumed by rent, mortgage, debt payments, insurance, healthcare costs, inflation-adjusted necessities, childcare, transportation, and 1,000 other quietly rising costs. People aren't failing to save because they're buying too many lattes. They're failing to save because the system has structurally made it impossible for most people to have anything left over after covering basic survival. People aren't failing retirement. Retirement is failing them. Pillar 3. Retirement has been financialized and turned into a product. Retirement used to be a life stage, a phase you entered after working, something that happened to you as part of the natural progression of a career in a system designed to support aging workers. Now, it's an industry, a market, a profit center, something that exists not to serve retirees, but to extract money from people worried about retirement. The retirement industry sells you 401k plans with multiple layers of fees that you barely understand. Target date funds that sound safe and simple, but charge management fees for doing what you could do yourself for free. IRAs with contribution limits and withdrawal rules and tax implications that require expert knowledge to navigate. Mutual funds with expense ratios that seem tiny but compound into huge amounts over decades. Annuities that promise guaranteed income but come with complex terms and high fees. Financial advisory services that charge 1% of your assets annually to tell you things you could learn from a book. Retirement seminars that are really sales pitches for expensive products. Retirement calculators that tell you you're behind and then conveniently suggest their services. Guaranteed income products that sound secure but have pages of fine print. Insurance-based retirement products that mix insurance and investing in ways that benefit the insurance company more than you. All sold with the same core message. You're responsible for your own future. The system won't save you. Your employer won't save you. The government won't save you. So you better buy our solution. You better pay our fees. You better sign up for our services, because without us, you're going to end up broke and in poverty. Fear is the marketing strategy. Insecurity is the product being sold. The more worried you are about retirement, the more likely you are to buy whatever they're offering. And nothing creates fear quite like the reality that most people actually won't be able to retire. So the industry doesn't need to manufacture that fear. It's genuinely there. They just need to position themselves as the solution, even though their products and services don't actually solve the structural problems that make retirement impossible for most people. The retirement industry isn't designed to help you retire. It's designed to profit from your anxiety about retirement while that anxiety lasts, which for most people is their entire working life. That's Pillar 3. Retirement became a market, and markets exist to extract profit, not to guarantee security for participants. Let's break down the math, the part nobody wants to show you clearly. Because once you actually see the numbers, not the vague inspirational calculator results, but the real concrete math, the illusion of retirement falls apart instantly. The math problem. No one prepared you. For most financial advisors will tell you the same thing, like it's settled wisdom. You'll need at least 70 to 80% of your pre-retirement income to maintain your lifestyle when you stop working. That sounds reasonable until you realize most Americans retire with less than $100,000 saved. Let that sink in. The median retirement savings for Americans approaching retirement age, people in their 60s who are about to need this money, is under $100,000. Many have far less. Many have nothing at all. And here's the brutal truth that nobody wants to state plainly. At retirement age, $100,000 is approximately 1 year of basic expenses for most people. Not 20 years of retirement. Not 15. Not 10. Not even 5 years. Just 1 year. Maybe 2 if you're extremely frugal and nothing goes wrong. And that's before you account for inflation, making your money worth less each year. Before unexpected medical bills. Before market crashes that might hit right when you're starting to withdraw. Before any of the 1,000 things that can and do go wrong when you're old and financially vulnerable. If this reality is hitting you, if you're doing this math in your head right now and feeling sick, comment reality. Because the numbers don't lie. The aspirational retirement marketing lies. The motivational financial advisor content lies. But basic arithmetic doesn't lie. And the arithmetic says most people are absolutely nowhere close to having enough saved. How much you actually need to retire. The real math. Let's be specific. Let's use actual numbers instead of vague percentages and hopeful projections. Most people who retire will need their money to last 20 to 30 years, depending on when they retire and how long they live. Some will need it for longer. Very few will need it for less unless they pass away shortly after retiring, which is its own tragedy. If your basic monthly expenses in retirement are $3,000, and that's pretty modest, that's not living large, that's covering housing, food, utilities, insurance, healthcare, transportation, basic necessities, that's $36,000 per year. Over 20 years, that's $720,000 you'll need. Over 30 years, that's $1,080,000, just for basic expenses at today's dollars. And that's assuming a whole bunch of things that are wildly optimistic, that you have no major health problems requiring expensive treatment or long-term care, that your housing situation remains stable, no major repairs, no need to move, no increases in property taxes or insurance, that you don't need to financially support family members who are struggling, that inflation stays relatively low so your expenses don't dramatically increase, that no emergencies happen, no car breaking down, no roof needing replacement, no dental work, nothing unexpected, that you pass away relatively quickly after 20 or 30 years rather than living into your 90s or beyond. None of those assumptions are realistic. Health problems are nearly universal as people age. Housing costs rise. Family members do need help. Inflation does happen. Emergencies do occur. People do live longer than expected. So the real number, the amount most people actually need to retire with any security and comfort today, is somewhere between $1 million and $1.5 million, depending on where you live and what kind of retirement you want. That's not a scare tactic. That's not financial advisors trying to sell you something. That's just basic math. Basic arithmetic applied to real costs and real life expectancy. And most people are nowhere close. Not even in the same universe as those numbers. Most people will reach retirement age with a tiny fraction of what they actually need. Which means they either can't retire at all, or they retire into poverty, or they retire briefly and then have to return to work when the money runs out faster than expected. The 401k trap. The 401k was sold as the solution. The democratization of retirement investing. The way ordinary people could build wealth through the stock market just like the rich do. Start early. Invest consistently. Compound interest is magic. Time in the market beats timing the market. You'll retire wealthy if you just follow the plan. But here's what they don't tell you about the 401k trap. 1. Markets crash every 7 to 10 years. It's not a bug, it's a feature. Boom and bust cycles are built into how markets work. Dot-com crash, housing crisis and financial meltdown. COVID crash, some new crisis we haven't seen yet. Each crash can wipe out 30 to 50% of your retirement savings overnight, sometimes more. And recovery takes years. If you're 30 when a crash hits, you have time to recover. Your losses are on paper. You keep contributing. The market eventually comes back. You're fine. But if you're 60 when a crash hits, if you're 63 and planning to retire in 2 years and suddenly half your savings evaporate, you don't have time to recover. You either keep working for another decade hoping the market recovers, or you retire with half what you plan to have. Either way, your retirement is destroyed by timing you couldn't control. 2. Fees destroy your money silently. A 1% annual management fee sounds tiny, barely noticeable. What's 1% of your money each year? But over 30 years, that tiny 1% fee can consume 25 to 30% of your total returns. Maybe more. That's not 1% of your contributions. That's roughly 1/4 of all the growth your money would have achieved. Gone. Transferred from your retirement account to the financial industry. They get paid no matter what. Bull market, bear market, crash, recovery. They take their percentage. You only get what's left after they've taken theirs. Your retirement success or failure doesn't affect their compensation. They win regardless. 3. Most people start too late. The advice is always, start early, let compound interest work its magic. But that's not realistic for most people. When you're young, in your 20s, you're likely making entry-level wages, possibly paying off student loans, trying to afford rent, maybe starting a family. There's nothing left to save. The compounding that's supposed to work magic can't happen if you can't afford to contribute. When you're middle-aged, 30s and 40s, expenses explode. Kids, bigger housing needs, healthcare costs, aging parents who need help, college savings, all hitting simultaneously. This is supposed to be your peak earning and saving years, but it's also when life costs the most. By the time you're older and maybe have more income available to save, you've lost the early years where compounding would have done the most work. Starting at 45 instead of 25 means you need to save dramatically more each month to reach the same ending balance. And most people can't afford those higher contributions. Life doesn't let you invest consistently from age 22, like the retirement calculators assume. Real life interrupts constantly. 4. Inflation eats everything. The retirement planning industry loves to show you projections. If you save $500 a month for 30 years at 7% returns, you'll have $600,000. Sounds great. Until you realize that $600,000 in 30 years won't buy what $600,000 buys today. The calculators usually assume 2 to 3% inflation. Nice, modest, official-sounding inflation. But the real inflation you experience in the costs that actually matter, healthcare, housing, education, insurance, food, is often 6 to 12% per year or more. Your savings can't keep up. The target keeps moving. You're saving in dollars that lose value while planning for expenses in dollars that cost more. The math is rigged against you from the start. 5. People live longer now, but not necessarily healthier. A generation ago, you might have needed 10 to 15 years of retirement income. You retired at 65, you passed away at 75 or 80, your money lasted. Now people routinely live into their 80s and 90s, which sounds good, longer life, until you realize what it means financially. You might need 20 to 30 years of retirement income, maybe more. And longer life doesn't mean healthier life. It often means more years of expensive medical care, medications, treatments, possibly nursing home or assisted living. Longer life equals more years of expenses, more years of healthcare costs, more years your money has to last. Not more years of freedom and comfort. More years of financial strain and vulnerability. The 401k system wasn't designed for this reality. It was designed for a world where people passed away younger and costs were lower and markets were more stable. It's failing because the world changed, but the system didn't. So if you're seeing how structurally broken this is, comment math. Because understanding that this isn't your personal failure to save or invest correctly, but rather a system designed in a way that can't deliver what it promises to most people, is critical. You're not bad at retirement planning. The retirement planning system is bad at creating actual retirement security. Why you're expected to work until 70 or beyond. Governments know you won't be able to retire. They can see the numbers better than anyone. They have access to all the data about savings rates, pension coverage, Social Security solvency, demographic trends. They know what's coming. That's why you're seeing, quietly and gradually, a systematic effort to keep people in the workforce longer. Retirement age quietly rising. The Social Security full retirement age has already increased from 65 to 67 for people born after 1960. There are regular discussions about raising it further to 68, 69, 70. Each increase means you have to work more years before you can collect full benefits. Social Security benefits pushed later. Early retirement is still available at 62, but with increasingly harsh penalties. The financial incentive structure pushes you to delay claiming as long as possible, ideally until 70. The longer you can be kept contributing rather than collecting, the better for the system's finances. Penalty-free retirement account withdrawals delayed. You can't touch your 401k or IRA without penalty until 59.5. Required minimum distributions don't start until 73. The system is structured to keep that money locked up, unavailable to you, for as long as possible. Politicians regularly suggest raising retirement age again. It's a recurring conversation. People are living longer, they're healthier, they can work longer. The solution to retirement insecurity is always work more years. Never fix the structural problems that make retirement unaffordable. Pension benefits shrinking. For the few who still have pensions, benefits have been cut, frozen, or eliminated through bankruptcy. Even promised pensions aren't guaranteed anymore. Work longer, becoming the official advice. Financial advisors, retirement planners, government publications, everyone's advice now includes consider working into your late 60s or early 70s. What used to be retirement age is now just mid-career. They're not increasing retirement age because you're living such a great, healthy life that you can keep participating in meaningful work joyfully into your 70s. They're increasing it because the system's finances don't work with current demographic realities. The math doesn't work at scale. You can't have a system where people live 30 years post-retirement. Pensions have been eliminated. Savings rates are inadequate. Healthcare costs are exploding. And the ratio of workers to retirees is shrinking. Something has to give. And what's giving is the expectation of retirement itself. The system is being quietly restructured around the assumption that most people will remain in the workforce until they physically can't continue. Modern retirement policy isn't built to support millions of people who stop working at 65 and live comfortably for decades. It's built to minimize costs by extending working years and providing minimal support for the shortest time possible. So the solution being implemented, not officially, but in practice, is work longer. Remain employed as long as possible. And when you finally do stop, the benefits are structured to cover basic survival, but not comfort or dignity or true security. That sounds harsh, but it's simply economics. It's the rational outcome of a system designed with specific constraints and incentives. Nobody had to conspire to create this outcome. It's just what happens when you have these structures interacting with demographic and economic realities. Why even $1 million isn't enough anymore. Let's say you somehow, through discipline and luck and good timing, managed to save $1,000 for retirement. $1 million. That sounds incredible. That sounds like you won. That sounds like financial security for life. Now let's apply actual math to that $1 million and see what it really means. You're 65. You just retired. You have $1,000 in retirement savings. Your life expectancy is roughly 20 more years, maybe more if you're healthy. Could be 25 or 30 years. Your expenses, housing, food, utilities, insurance, healthcare, transportation, basic necessities, run about $50,000 per year. That's modest. That's not traveling the world or living lavishly. That's a basic middle-class existence. Simple division, $1,000, $50,000 a year to use 20 years. So your $1 million lasts exactly 20 years if, and this is a massive if, everything goes perfectly. If all these conditions hold, markets don't crash and wipe out a chunk of your savings right when you're drawing from them. Inflation stays low, and your $50,000 year of expenses doesn't become $60,000 or $70,000 or more. You don't get seriously ill and incur major medical expenses beyond what insurance covers. You don't need long-term care, which can cost $80,000 to $120,000 per year or more. Your home doesn't need major repairs or replacements. No new roof, no new HVAC, no foundation issues. You don't financially support family members who are struggling. None of your major appliances break. Your car doesn't need replacing. No emergencies of any kind happen for 20 years. That's absurd. That's fantasy. Real life doesn't work that way. Things break. People get sick. Costs rise. Emergencies happen. Markets crash. Inflation eats away at purchasing power. So in reality, your $1 million, if you manage to accumulate it at all, might last 15 years. Maybe less. And if you live longer than that, which many people do, you run out of money while still alive, while still needing food and housing and medical care. Suddenly, your million doesn't look like security. It looks like a temporary cushion that will eventually run out, leaving you financially vulnerable when you're too old to do anything about it. And remember, the vast majority of people will never reach even half of that $1 million. Most people will retire with a small fraction of what they actually need. That's why retirement is an illusion for most people. The math doesn't work. The goalposts keep moving. The target keeps getting farther away. And the system keeps insisting that if you're not reaching that target, it's your personal failure rather than a structural impossibility. The retirement system only works if you keep working. Here's the part nobody wants to admit openly, the uncomfortable truth that undermines the entire narrative of retirement as a universal phase of life everyone progresses to. The retirement system we have, Social Security, 401ks, the whole structure, is not designed to support a majority of the population actually retiring and living comfortably for decades without working. It only works if most people keep contributing, keep investing, keep working, keep the system funded. It only works if very few people actually successfully retire. It only works if most people either can't afford to stop working, or retire briefly and then return to work, or retire into poverty and minimal consumption. Think about Social Security. It's a pay-as-you-go system. Current workers' payroll taxes fund current retirees' benefits. The system works as long as you have enough workers paying in to cover the retirees collecting. But demographics are shifting. Fewer workers, more retirees. The ratio that used to be maybe 5 or 6 workers per retiree is heading toward 2 or 3 workers per retiree. The math breaks. The system can't sustain full benefits for everyone without either massive tax increases on workers or benefit cuts for retirees. So what's the solution the system is implementing? Keep people working longer. Raise retirement age. Reduce benefits by pushing people to claim later. Means test benefits. So wealthier retirees get less. All mechanisms to reduce the burden of supporting non-working retirees. Think about 401ks and the stock market. The system needs constant inflows of new money. Workers contributing to their 401ks every month. That money flowing into stocks and bonds, keeping markets liquid and prices rising. If everyone actually retired successfully, if millions of people stopped contributing and started withdrawing simultaneously, the market couldn't handle it. Too much selling pressure, not enough buying. Prices would collapse, the system would break. So the system needs you to keep contributing, keep working, keep being a buyer rather than a seller, keep being a source of new money flowing in rather than a drain of money flowing out. The system doesn't want mass retirement, it wants mass continued participation in the workforce. It wants you productive, earning, consuming, contributing to Social Security, contributing to your 401k, generating economic activity. Retirees, from the system's perspective, are a cost. They consume, but don't produce. They draw benefits, but don't pay in. They sell investments, but don't buy. They're a drain on the system rather than a contributor to it. That's not moral judgment. That's just mechanical reality. The system is designed around economic growth, requiring participation. And participation means working. That's why you see 70-year-olds at cash registers. Not because they want to be there, not because they're bored at home, but because their retirement savings ran out or were never adequate, because Social Security alone isn't enough to live on, because the system that was supposed to support them failed them, so they're back to work out of necessity. And that's by design. Not explicit design. No policy document says we need seniors working service jobs, but design in terms of incentives and structures and inevitable outcomes. The system is built in a way that produces this result, and that result is what keeps the system functioning. If most people could actually afford to retire comfortably and did so, the system would face serious sustainability challenges. So the system prevents that from happening, not through conspiracy, but through structure. You're not supposed to retire successfully. You're supposed to keep working. That's what makes the system sustainable from the system's perspective. Your inability to retire isn't a bug, it's a feature. So what do you actually do? No false hope here, no magic fixes, no just invest more platitudes, no skip the lattes nonsense that ignores the structural realities we've just laid out. You can't solve a systemic problem with individual discipline alone. You can't save your way out of a system designed to keep you economically insecure. You can't invest your way to guaranteed retirement when the system has shifted all risk onto you and eliminated the guarantees that used to exist. But, and this is important, understanding that you can't solve the systemic problem doesn't mean you're completely powerless. It means you need different strategies. Strategies that acknowledge reality instead of pretending that if you just follow the traditional advice, everything will work out. You can build some leverage, some control, some security within a broken system. Not perfect security, not guaranteed comfortable retirement in the traditional sense, but better than just hoping the system will somehow work out for you when it's clearly failing millions of others. The new goal, not retirement, but work optional. The old definition of retirement was, stop working completely and forever at age 65, live off savings and pension and Social Security until you pass away. That definition is dead for most people. That world doesn't exist anymore. You need to let go of that expectation and the guilt and shame that comes from failing to meet it. The modern version, the realistic version that might actually be achievable, is this. Build enough income, enough stability, enough financial cushion that work becomes optional rather than required for survival. Not quit your job forever and never work again. Not stop at 65 no matter what. But reach a point where you could stop if you needed to, where you could take a year off, where you could switch to part-time, where you could leave a toxic job without immediate financial catastrophe. That's freedom in the 2020s and beyond. Not permanent retirement, but optionality, flexibility, the ability to say no. the power to work on your terms rather than out of desperate necessity. Your grandparents had pensions that gave them security. You're not going to have that. So instead, you need to build personal autonomy, or you don't have anything. And the system won't hand that to you. Nobody's going to give you optionality. You have to build it intentionally, piece by piece, understanding that it won't look like traditional retirement, but it's better than working out of desperation until you physically can't anymore. If this is landing differently than the usual retirement advice, if you're seeing why just save more doesn't address the actual structural problems, hit subscribe. Because the follow-up to this is going to be specific, concrete strategies for building actual financial security in a system that's designed to prevent it. Your real lifeline isn't savings, it's cash flow. The retirement industry wants you focused on one number, the total amount saved. $1 million is the goal. You need $1.5 million to retire comfortably. Everything is about reaching that magic lump sum. But here's a different way to think about security. What if the goal wasn't a number, but a flow? What if instead of trying to accumulate enough money that you can live off withdrawals for 30 years, you built enough ongoing income streams that you didn't need a giant pile of money? Because someone with $400 per month in passive income from some combination of sources, plus the ability to work part-time doing something they don't hate, plus relatively low fixed expenses, plus no high-interest debt eating them alive, that person has more actual freedom and security than someone with $200,000 saved, but expenses that consume it quickly and no income except withdrawals from a shrinking account. Cash flow is different from savings. Savings run out. Savings get depleted. Savings are vulnerable to market crashes and inflation and living longer than expected. Savings create constant anxiety about whether you're withdrawing too much, whether the money will last, whether you should have saved more. Cash flow continues. Income streams, if structured well, keep generating money. Social Security keeps coming every month. A rental property keeps generating rent. Dividend-paying investments keep paying dividends. A small online business keeps producing revenue. Part-time consulting keeps bringing in fees. Multiple small streams of income are often more reliable than one large pile of savings. Because if one stream dries up, you still have others. But if your savings run out, you have nothing. The future belongs to people who design streams of income rather than just accumulating stacks of cash. Cash flow over nest egg. Always. This doesn't mean don't save anything. It means prioritize building income-generating capacity alongside or even above pure accumulation. Because $500 a month you don't have to withdraw from savings is worth more than having $150,000 saved that you're slowly depleting. Reduce your monthly burn rate. The real retirement hack. Most retirement advice focuses on the accumulation side. Save more, invest better, work longer, accumulate a bigger number. But there's another side that's often more achievable and more impactful. Reduce the amount you need every month to survive. Your biggest enemy isn't lack of savings. It's your fixed monthly expenses, your burn rate, the amount you must spend every month just to keep existing. Rent or mortgage, loan payments, insurance premiums, subscriptions, debt service, utilities, all the recurring costs that happen automatically whether you have income or not. Most people focus on, I need $1 million to retire. But what if instead you thought, I need to get my monthly required expenses down to a level where modest income covers them? Because here's some math that changes everything. Cutting $1,000 per month in expenses is financially equivalent to having about $300,000 invested at a 4% withdrawal rate. Yes. Reducing your monthly burn rate by $1,000, which might be achievable through paying off a car, eliminating debt, downsizing housing, cutting unnecessary subscriptions, has the same financial impact as magically having $300,000 more in retirement savings. Nobody tells you this, because the financial industry can't sell you products that help you spend less. They can only sell you products to help you save and invest more. But from a pure financial security perspective, reducing expenses is often more achievable and more impactful than increasing savings. So the real question becomes, how do you shrink your required monthly cost of living so that work stops being a prison and starts being optional? Pay off your car and keep driving it instead of upgrading. Eliminate high-interest debt completely. Move to a lower cost of living area if possible and practical. Downsize housing when kids move out instead of keeping the big house. Cut subscriptions you barely use. Refinance your mortgage if rates drop. Shop around for insurance annually. Cook more, eat out less. Not deprivation, not living miserably, but intentional reduction of fixed costs that don't actually add much value to your life. Because every $100 you cut from monthly expenses is like having $30,000 more saved. That math is powerful. And it's achievable in ways that saving $30,000 often isn't. Pay off high-interest debt. For freedom, not morality. Debt isn't a moral issue. It's a mathematical issue. And high-interest debt is reverse retirement. Think about it. Instead of having money working for you and earning returns, you have money working against you and costing you returns. Instead of earning 7% on investments, you're paying 22% on credit card debt. The math is brutal. $1 of credit card debt at 22% APR costs you 22 cents per year in interest. To break even, you'd need investments returning 22% per year, which is impossible to achieve consistently. Even in good years, even with perfect timing, even with risk you shouldn't be taking, you can't reliably get 22% returns. So paying off high-interest debt isn't about morality or responsibility or being a good person. It's about math. It's about stopping the bleeding. It's about eliminating a cost that makes financial security impossible. Clearing high-interest debt is the closest thing to a guaranteed return in modern finance. You're not going to get a guaranteed 22% return on any investment. But paying off 22% debt is mathematically equivalent to earning 22% risk-free. You're not paying debt for moral reasons or because someone yelled at you about being debt-free. You're paying it because freedom, real freedom, work-optional freedom, requires low fixed costs. And debt service is a fixed cost that eats your money every month regardless of whether you're working or not. The less you owe others, the more of your future time belongs to you. Every dollar of monthly debt payment you eliminate is a dollar less you need to earn, which means you need less savings to retire, which means work becomes optional sooner. This is strategic, not moral. This is math, not judgment. High-interest debt makes work optional impossible. Eliminating it makes work optional achievable. Skills are the new pension. Your grandparents retired with pensions. Guaranteed income for life based on years of service. They didn't need to worry about staying employable or relevant. They just needed to show up for 30 years, and the company would take care of them afterward. You don't have that. You're never going to have that. So what's your equivalent? Skills. Portable, valuable, in-demand skills that you control and that the market wants. Skills that let you earn money on your terms rather than being completely dependent on one employer who can fire you at any moment. The modern economy rewards people who can adapt, who can learn new tools quickly, who can pivot when industries change, who aren't tied to one specific job or company or even career. It rewards people with skills that are portable, not tied to one employer or location. In demand, people will pay for them. Hard to automate, not easily replaced by AI or systems. Learnable, you can develop them without decades of specialized training. What are those skills? Different for different people, but some examples. Writing and communication. If you can write clearly, persuasively, engagingly, people will pay for that. Content, copy, articles, emails, scripts, social media. The specific medium changes, but the skill of communicating effectively doesn't. Sales, and persuasion. If you can sell, if you can convince people to buy or act or agree, you'll never be unemployed. Sales skills transfer across industries. A good salesperson can sell cars or software or insurance or consulting. Technical skills that are currently in demand and are likely to stay in demand. Data analysis, basic coding, digital marketing, SEO, graphic design, video editing, project management. These specific tools change, but the general category of technical skills that businesses need stays valuable. Teaching and coaching. If you can teach something, any skill, any subject, there's a market for it. Online courses, consulting, coaching, training. The format changes, but the demand for people who can teach effectively doesn't. Problem solving and analysis. If you can look at a business problem and figure out solutions, that's valuable across contexts. Consultants, strategists, analysts, they're all selling the same core skill of I can help you solve this. You don't need to become an expert in all of these. You need one or two that fit your interests and abilities. One or two skills that the market values and that you control. That you can take with you from job to job. That you can use full-time or part-time. That you can monetize directly if needed. That's your pension. Not a guaranteed monthly check, but the ability to generate income when you need it because you have skills people will pay for. And unlike a pension that can be taken away, that can be lost in bankruptcy, that depends on your employer staying solvent. Skills are yours. They go where you go. They can't be repossessed. They're your portable security. Own a piece of something, anything, that grows while you sleep. You don't need to become a millionaire investor. You don't need to become a real estate mogul or start the next Facebook. You don't need to build an empire. But you do need to own something, even something small, that appreciates or produces income without requiring your constant active labor. Something that has a chance of growing in value while you're doing other things. Something that might generate cash flow without you trading hours for dollars. Could be a small position in index funds that you add to consistently, that grows with the market over decades, that might eventually generate dividends or can be drawn from in retirement. Some real estate equity, maybe not a whole rental property, but a share in a rental through REITs, or a house you own that builds equity, or eventually a paid-off home that you can downsize from or reverse mortgage, or that your heirs can sell. A micro business, something online that might generate some income. Selling digital products, affiliate marketing, a small service business. Doesn't have to make you rich. Just needs to generate some money without requiring full-time attention. An online presence or audience, if you build an audience through content, through social media, through a blog or YouTube channel or podcast, that audience has value. It can be monetized. Maybe not enough to replace a job, but enough to supplement income. Royalties from something you created. Write a book, create a course, build a product, make something that might generate small ongoing payments for years after you create it. Anything where you put in work once and it has potential to generate value multiple times. Where you own something rather than just earning wages for hours worked. Ownership is leverage. Wage work is dependency. The retirement illusion collapses when you rely 100% on wages. Because wages stop when you stop working. And if you can't save enough from wages to live off forever, you're trapped. But if you own even 1% of something valuable, something that might grow, something that might generate income, something that might appreciate, you've created leverage. You've built a tiny bit of security that doesn't depend on you being able to work. It doesn't have to be big. A small index fund portfolio. A paid-off rental property that generates $500 a month. A digital product that sells a few copies each month. An online business that brings in $200 here and there. A skill you can monetize on demand. The specific form doesn't matter. What matters is that you own something rather than just earning wages. Because ownership compounds. Ownership has a chance of growing without additional labor. Ownership creates options. Wages are linear. You work an hour, you get paid for an hour. You stop working, the money stops. There's no leverage, no compounding, no growth beyond trading more hours. Ownership is exponential, or at least has exponential potential. You build something once, it might generate value for years. You buy something, it might appreciate. You create something, it might sell repeatedly. Even tiny ownership beats pure wage dependency. Because pure wage dependency means you're one job loss away from having nothing. But ownership, even small ownership, means you have something that exists independently of your current employment situation. Freedom doesn't come from quitting, it comes from control. The fantasy that retirement advice sells you is, one day you'll stop working completely and forever. You'll never have to work again. You'll spend your days relaxing, traveling, pursuing hobbies, living off your savings. That fantasy keeps people trapped. Because it's unachievable for most people, which makes them feel like failures. And it's not even necessarily desirable. Most people don't actually want to never work again. They want to stop being forced to work jobs they hate out of financial desperation. There's a difference. A big difference. The reality, the achievable version of freedom, is this. Freedom is when you can say, I don't want this job anymore. I'm leaving. I'll find something else or take time off or figure it out, but I'm not staying in a situation that's destroying me. I'm taking 3 months off. My savings and other income streams can cover my basic expenses. I need a break, and I'm taking it. I'm going to work part-time for a while. I don't need full-time income right now, and I'd rather have time than money for this period of my life. I'm starting my own thing. It might fail, but I have enough cushion that I can try without immediately facing financial disaster if it doesn't work out. You can't treat me this way. I have options. I have savings. I have skills. I have other income sources. I don't need to tolerate mistreatment or exploitation because I'm desperate. That's freedom. Not never working. But having enough options that work is a choice rather than a desperate requirement for survival. Options equal freedom. Control equals freedom. Work optional equals freedom. Someone with $50,000 saved, low expenses, multiple income streams, in-demand skills, and the confidence to leave bad situations has more real freedom than someone with $500,000 saved, but massive fixed expenses, total dependence on one job, and terror of ever being unemployed. Freedom isn't a number in an account. Freedom is the ability to say no, the power to make choices, the security to take risks, the leverage to negotiate from a position of non-desperation. Retirement, the old version, the permanent quit and never work again version, is optional now. Most people won't achieve it, and that's okay. It was always somewhat of a historical anomaly anyway. But freedom? Freedom was never optional. Freedom is necessary. And freedom in the modern economy looks different than it did for previous generations, but it's still achievable if you understand what you're actually building toward. You're not building toward a magic day when you stop working forever. You're building toward the ability to work on your terms, to say yes to what serves you and no to what doesn't, to have choices, to have leverage, to have control over your own time and energy in life. That's the real goal. That's what's achievable. That's what makes the struggle worth it. The retirement system didn't collapse. It was never built for you. And here's the truth. Most people never hear clearly enough to really understand. The retirement system we have today wasn't designed for a world where people live 30 years after age 65. It wasn't designed for a world where housing costs 12 times median income. It wasn't designed for a world where wages stagnate for 40 years while productivity soars. It wasn't designed for a world where healthcare costs can bankrupt you. It wasn't designed for a world where student debt delays every major life milestone. It wasn't designed for a world where one income can't support a family. It wasn't designed for a world where inflation eats away at purchasing power constantly. It wasn't designed for a world where corporations eliminate pensions. It wasn't designed for a world where benefits disappear. It wasn't designed for a world where gig work replaces stable employment. The system was designed for a completely different world, a world where people passed away younger, where houses were affordable, where wages grew, where healthcare was manageable, where education was cheap, where one income was enough, where pensions existed, where employers provided security. That world is gone. It's not coming back. The system didn't adapt. It didn't get rebuilt for new realities. It just kept pretending the old assumptions still held while the ground shifted completely underneath it. So the system didn't fail. It didn't collapse. It never actually worked for the world you're living in. You were sold an outdated dream from a world that no longer exists, and then blamed for failing to achieve something that was structurally impossible under current conditions. Once you see that clearly, once you really understand that this isn't about your personal failures or bad choices or lack of discipline, you stop feeling guilty. You stop blaming yourself. You stop thinking you're broken for not being able to save enough or invest perfectly or reach impossible goals with inadequate resources. You're not the problem. The system is. The expectations are. The advice that assumes conditions that don't exist anymore is. You're not failing at a fair system. You're navigating an unfair system that was built for someone else's reality and never updated for yours. That clarity, that understanding, is liberating, because it means you can stop trying to meet impossible standards and start building security in ways that actually work in the world that actually exists. So, what's the real path forward? Right now? Today? Not someday. Not after the system gets fixed, or the government does something, or conditions improve. Right now, in the reality you're actually living in, with the resources you actually have. Here's the modern, realistic, achievable roadmap for building financial security in a system that's designed to prevent it. 1. Lower your monthly fixed costs aggressively. Every $100 you cut from required monthly expenses is mathematically equivalent to having about $30,000 more in retirement savings. That's not metaphorical. That's actual financial math. If you can cut $1,000 from monthly fixed costs, that's like having $300,000 more saved. This isn't about deprivation or misery. This is about intentionally reducing recurring costs that don't add much value to your life. Housing is usually the biggest one. Can you eventually move somewhere cheaper, downsize when it makes sense, pay off your mortgage, get roommates? Debt service is next. Can you eliminate monthly payments? Then insurance, subscriptions, recurring services. Can you shop around, cut what you barely use, reduce what's negotiable? This is the most powerful lever most people have because it's achievable. You might never save an extra $300,000. But you might be able to cut $1,000 in monthly expenses through strategic choices over time. Same financial impact, more achievable path. 2. Kill high-interest debt like it's trying to destroy your future, because it is. Not for moral reasons, not because debt is shameful, but because high-interest debt makes financial security mathematically impossible. You cannot build wealth while paying 22% interest to credit card companies. You cannot achieve work optional while servicing debt that costs you hundreds of dollars every month. This isn't about being debt-free as a status symbol. This is about eliminating the single biggest obstacle to having any money left over after necessities. Pay it off however you can. Snowball method, avalanche method, consolidation if you can get lower rates, whatever works. Just get rid of it. Every dollar of monthly debt payment you eliminate is a dollar less you need to earn forever, which means you need less income, which means you need less savings, which means work becomes optional sooner. 3. Build one small income stream that doesn't depend on your main job. Not a business empire, not something that will make you rich. just $200 to $500 per month to start. Something that proves to you that income can come from sources other than your employer. Could be freelancing a skill you have. Could be a small online business. Could be consulting or coaching. Could be creating something digital that might sell. Could be a side gig using the gig economy platforms. Could be renting out space or possessions you're not using. The amount doesn't matter at first. What matters is breaking the psychological dependence on your employer as your only source of income. What matters is proving that you can generate money independently. What matters is building the confidence and skills to create income on your terms. That small income stream might never replace your job, but it might supplement it enough to give you choices. It might grow into something bigger over time. It might become your safety net if your job disappears. It might be what lets you negotiate better terms because you're not completely desperate. 4. Develop one in-demand portable skill that you own and control. Not necessarily related to your current job, not necessarily something you'll use immediately, but something that has market value, something people will pay for, something you could monetize if needed. Writing, sales, marketing, design, coding, data analysis, project management, teaching, consulting, repair skills, creative skills, technical skills, people skills. Pick something that interests you enough to develop it, something that fits your natural abilities, something that has demand, something that's not easily automated, something portable that you can take with you anywhere. You don't need to become world-class. You need to become good enough that someone would pay you for it. That's your insurance policy. That's your pension replacement. That's your security in a world where jobs disappear and companies fail and industries change. One skill can completely alter your trajectory because it means you're never truly unemployable. You always have something you can sell. You always have options. 5. Start owning something, even if it's tiny. Even $50 per month into a broad index fund matters. Even a small side business that might generate some income matters. Even a hobby that might eventually monetize matters. Even building an audience online that might have value matters. Start somewhere. Ownership of anything beats ownership of nothing. A tiny position that might grow beats no position at all. Any leverage beats pure wage dependency. You're not trying to get rich from this. You're trying to have something, anything, that exists independently of your current job. Something that might appreciate, something that might generate income, something that might provide options. The specific vehicle matters less than the act of owning rather than just earning. Because ownership creates possibilities that wage work doesn't. 6. Aim for work optional, not never work again. Stop measuring yourself against the fantasy of permanent retirement at 65. That's not realistic for most people, and honestly, probably not even desirable for many. Instead, aim for the ability to work on your terms, to say no to bad situations, to take breaks when needed, to reduce hours if you want, to switch careers without catastrophe, to have options and leverage and control. That's achievable. That's worth building toward. That's what actually creates freedom in the modern economy. Someone who reaches 60 with low fixed costs, some savings, multiple income streams, valuable skills, and optionality has achieved something more valuable than someone who reaches 60 with a big pile of money, but massive expenses and total dependence on that pile lasting an unknowable number of years. 7. Stop waiting for the system to fix itself or for perfect conditions. The system isn't going to fix itself. Political solutions aren't coming to save you. Economic conditions aren't going to suddenly shift in workers' favor. The retirement system isn't going to be redesigned to actually provide retirement security. You have to build security within the broken system, using the tools available, in the conditions that exist, without waiting for someone to make it easier. That's not fair. That's not how it should be. But it's how it is. And accepting that reality frees you to act effectively rather than waiting helplessly for things to change. You're not going to single-handedly fix systemic inequality, but you can build personal leverage. You can create options. You can reduce your vulnerability. You can improve your position even while the system stays broken. That's the path. Not perfect, not guaranteed, not fair, but possible, achievable, real. You're not stuck. You're early to the truth. Most people will figure this out at 60. They'll reach traditional retirement age, look at their savings, realize it's nowhere close to enough, and panic. They'll feel betrayed by a system that promised them security and didn't deliver. They'll struggle with the reality that they can't stop working when they thought they would. You're figuring it out now, earlier, while you still have time to adjust your strategy, while you still have working years ahead to build different forms of security than the ones you were promised. That's not a disadvantage. That's actually an advantage. You're not wasting years pursuing goals that were never achievable. You're not building your entire life plan around assumptions that don't hold anymore. You're seeing reality clearly while you can still do something about it. If you've ever felt like, I'm behind, I'll never be able to retire, I did everything right and nothing worked. Why is this so hard when it seemed easy for previous generations? You're not failing. You're waking up. You're seeing clearly. And that clarity, however painful, is the first step to building something that actually works. Being behind an impossible standard isn't the same as being behind a reasonable goal. Failing to achieve something that was structurally unachievable isn't personal failure. Struggling in a rigged system doesn't mean you're bad at the game. You're just playing a different game than your parents played, with different rules, different resources, different obstacles, and most of the advice you've received was about their game, not yours. Once you see that, once you really understand the structural reality you're facing, instead of blaming yourself for not meeting outdated standards, everything shifts. You stop feeling guilty. You stop feeling broken. You stop measuring yourself against impossible metrics, and you start building security in ways that actually work for the world you actually live in. Final message: what freedom actually looks like. Now. Here's the truth they don't want you to understand. You don't need millions to be free. You don't need to achieve traditional retirement. You don't need to match what your parents had or what financial advisors say you should have. You need control. You need options. You need low fixed costs. You need some form of ownership. You need income that's not completely tied to one employer. You need skills that have market value. You need the confidence to say no to situations that harm you. You need to build a life where work is a choice, not a prison, not a sentence you're serving, not the only thing keeping you alive, not something you're desperately dependent on because you have no alternatives. That's the new retirement. That's modern freedom. Not stop working forever at 65 and live off a pile of money for 30 years. But stop being completely controlled by the necessity of work. Stop being so economically vulnerable that you have to accept any terms offered. Stop being trapped. Work becomes something you do because it's meaningful, or interesting, or financially worthwhile on your terms. Not something you do because you'll be homeless if you stop. Not something you endure because you have no choice. That's the real escape. That's what's achievable. That's what's worth building toward. You're not building toward a magic day when everything changes and you're suddenly retired and free. You're building toward gradually increasing levels of optionality and control and security. Toward each year having slightly more freedom than the last. Toward slowly shifting the power dynamic so you're less trapped and more choosing. It's not dramatic. It's not a finish line you cross. It's a gradual accumulation of small advantages that compound into meaningful freedom over time. And it starts with seeing clearly. Understanding what you're actually facing instead of what you were told you'd face. Letting go of impossible standards and building toward achievable security. The retirement system is broken. It was never built for you. It can't deliver what it promises to most people. But you can still build freedom. Different freedom. Modern freedom. Real freedom that actually exists in the world as it actually is. If you want the follow-up, the specific tactical version of this, the anti-retirement plan, how regular people build freedom without millions, comment freedom, and I'll make it next. Because this video was about seeing clearly, understanding the problem, letting go of illusions. The next one will be about building solutions, concrete strategies, specific tactics, real paths to work-optional freedom that don't require winning the lottery, or getting lucky, or having resources you don't have. You're not stuck. You're not failing. You're just playing a different game than the one you thought you were playing. Once you see the real game clearly, you can start winning at it.